Welcome to ADJ Knowledge Academy. This is Anand Jonathan, and I hope you have viewed my previous video on complete analysis of Russia and Ukraine war. This crisis is a major trigger point for the trembling economic situation across the world and India. In this lecture, we are going to discuss what are those factors that led to this major global economic crisis, particularly in H1 of 2022. That has delivered a body blow impact on the growth and sustainable economic situation in India. Since due to globalization, today economy of no country is sun-proof from the negative impact that the world faces today. Hence, it becomes very important for us to understand the core factors that cause this explosion in the economic crisis. This will help us to navigate our lives easily through this economic crisis. I hope this will help. Let's turn to the lecture now. Let us discuss the major factors that led to the stagnancy in the economic growth or GDP of India. Some of the factors listed here are due to internal policies within India, and others are due to the global impact. As iterative earlier, no country today is sun-proof from any major global event that has historical reference or impact to any major economy across the world like US, China, Japan, India, France, Germany, UK, and Australia among others. So the slowness was already observed in the Indian economy when the reins were handed over to the Modi government in 2014. But it took further brunt when the good ideas like deep modernization and GST were rolled out in a complex environment and market like in India. The business output declined and the GDP took significant impact between 2014 through 2022. Further, when Donald Trump was elected as the President of the United States, it came as a good news to India. But this couldn't last longer due to US confrontation with China in the Northeast Asia region. Donald Trump administration waged an economic war with China, which impacted not only China's economy but US as well, and thus endangered the world economy as a whole, since China is the world's manufacturing hub and US being the topmost economy of the world. While this economic war was going on, the COVID 19 pandemic ravaged major and minor economies in the world, and it is still ravaging. This destroyed the supply chains as the major metro cities across the world were in lockdown. This marked the total GDP of the world going into a state of recession almost immediately in 2020. While the world was still battling the COVID 19 pandemic, the Russia Ukraine war further aggravated the situation. In much likeliness, this crisis will be a protracted war with potential of a full-blown larger conflict with NATO and even nuclear war in future. All these international events have contributed to major economic crisis, and Russia-Ukraine war is a trigger point according to me. This has led to all type of problems for the world like soaring oil prices, very high prices for the essential commodities, looming recessions in the western countries. Due to this, central banks of major economies like US, India, France, UK are now forced to raise the repo rates by a historical high to help cool down the inflation, which is at the peak level in European and Western countries. While Russo and Ukraine war drags on, the West has consolidated its position within NATO by adding Sweden and Finland, who were previously neutral countries between West and Russia. This will have a provoking impact on Russia, and hence the current war crisis is likely to continue or a very high probability to spread or to other parts of the world like Baltic nations or Japan. While targeting Russia through sanctions, NATO, West, and European countries are also taking on China by heavily investing $600 billion towards infrastructure projects, similar to that of China's One Belt, One Road projects. This is to counter the Chinese influence, and the US have also banned Chinese goods from the Xinjiang province of China due to a known issue of forced labors of Uyghur Muslims population. Last but not the least, the business activities are slowing down due to the disruption in the supply chains since supply chains and lines across the world due to the COVID-19 pandemic, creating an acute shortage of semiconductors across the world. A good example of this is that we observe in our daily lives. If customer goes and buy a car, the waiting time for the delivery is easily anywhere around 9 to 12 months. Yeah. All right. So now we'll discuss the impact. Yep. So talking about the impact, there was an overarching impact of this economic fallout and has impacted every Indian and sector in India. The rupee currency is continuously dropping and weakening against the dollar. Currently, when I'm recording this video, it is 79 basis points against the dollar already. While the current account deficit of India has consistently widened due to this impact, is a bad news for the industries dependent on the imported items within the country, as well as the total dollar reserve of India has also significantly reduced, as drop in currency values was a direct impact of the rising CPI inflation in the country. Rising prices of the commodities like crude oil, palm oil, wheat, urea, fertilizers, etc., and contributed by India's debt bond loan payments. All this had a ripple impact on the India's stock market, as the investors are now concerned whether the companies wherein they have invested their hard-earned money will be able to maintain the revenue and profit margin due to the record high inflation. To curb the record high inflation in most of the major economies across the world, the banks have of respective countries have increased their lending rates by a number that is historically very high. By the principle of demand and supply, the demand has to be reduced significantly to manage the internal inflation. The Reserve Bank of India has increased the lending rate for the bank twice already, and the third increase is already pending. This move, while it is very important to do so, has further made the investors nervous about the impending economic situation, since drop in the demand and very high inflation would mean cancellation of imported import orders, and high pressure on the to maintain margins on the manufacturing and metal businesses among others, as well as to maintain the top line growth. Also, the looming risk of the recession in Western countries has caused the foreign institution investors being nervous, forcing them to pull out their money from the Indian stock market and investing them into the US GSEC bond or debt investment, contributed by tens of thousands of job losses in various sectors, particularly in startups. In India, the impact has been as GST on number of goods have been levied and increased, and a number of goods previously exempted by from the GST are now taxed under the GST rule. These are the major causes for the turbulent times in the Indian stock market. Though India is considered the safest and most promising countries for the equity investors, the events occurred in recent past has triggered an alarming situation and has made a lot of foreign institutional investors, domestic institutional investors, and normal investors to pull back their money, which has resulted in the crash of Indian stock market more than 10 to 12% when we talk about the Nifty 50 benchmark. And all this has happened within 6 months of duration. So as you all know that the let's move on to the next slide, which shows the stock market trends over different timelines. Here we have considered the popular benchmark as Nifty 50 for analysis and study to relate to these factors that I have shared with you in my previous slide, along with the deep impacts that we are facing currently, right? And all this from a Indian share market standpoint. The first graph shows that the Indian stock market has given promising results to its long-term investors for the period greater than 5 years, which means if we look at the historical data points, these give us a sense of perspective that Indian stock market and businesses, its output, scalability, and impact and fundamentals, growth outlook, government economic and business policy have given good results to the investors when we look at the first graph here, right here. The next bottom chart also shows the growth in this story, wherein the investors who have invested 5 years ago might have earned 65% um, of the returns on the amount invested already. But the key status changes when we look at the stock market movement in 1 year, Y2D, 6 months, and or even a month ago. The trend is contributed by the factors and impact that we have discussed earlier. But it's clear that the latest trend that we are seeing in recent duration of 1 year is temporary. And once that international issues are subsided, the stock market bull run will be back again in India since the fundamentals and business policies are very good in India already. This is the reason for most of the foreign institutional investors and retail investors now choose India as a destination for investment. With that said, it would be a good idea for the investors to buy stock in dips to make their positions in fundamentally good stocks and not to panic when stock market falls, since we will observe this volatility in the stock market for a couple of quarters, at least until Russo-Ukraine war is over. So let's move on to the next slide. Yeah. All right. So my next slide talks about the compounding impact, how an investor perceive it, right? This slide is particularly for an investor who is a beginner or who has spent 2 to 3 years in stock market. We saw the compounding effect in my previous slide in the first graph that it takes place over a duration of time, like where we see that over a period of time there is a compounding effect. Likewise, if you see here, within the period of 5 years, there's a compounding effect which is going on. Your returns are getting high, right? The ideal investor would think that the stock prices only go up and up, particularly for those who saw and experienced the bull run in H2 of 2020 and 2021. The but now the bearishness of the market in the situation is making many of us very nervous and even depressed when they see their investment depreciated even by minus 20%. I just wanted to show you that the compounding impact in stock market happens over the long time, and also since it's a very high risk asset, there will be times when we see dips and volatility. We need to trust our fundamental analysis and company that we have trusted and invested our money. The sun will shine again. I just want to tell you the sun will shine again. Compare this with the risk-free investment like PPF, where the compounding impact is positive but yields very less returns to its investors. Next slide, I have a Nifty 50 index analysis in front of you, as it is very important to invest in large companies who have very strong fundamentals, since they can serve as a defensive stock and as well as a growth stock whenever the mood of the market is bearish. This analysis will help you as an investor to look at the companies from a safe investment perspective in times like these, since this on a minimum ensures our investments are safe. I believe that the best companies to stay invested would be those who have a very high market capitalization. Hence, you will see all the companies listed in Nifty ranked on the basis of market capitalization or market cap. These are the top 50 companies. I have done the Pareto in this case as well. Let's observe that the top 10 companies in Nifty 50 contributes almost 50% of the total market cap. So, if we invest in this company, that will mean investing in the top companies in India. Would anything happen to them in long and short term? The answer would be a big no. Would say only if something very bad happens to India as a sovereign, democratic, and independent country. The top 10 companies in Nifty 50 index are Reliance, TCS, HDFC Bank, Infosys, Hindustan Unilever, ICICI Bank, Life Insurance Corporation, SBI, Airtel, HDFC Limited. You all must have heard the latest news of the merger of the HDFC twin stocks, HDFC Bank and HDFC Limited, that is most likely to create the second largest company by market cap on Nifty 50, replacing the TCS. Next, please observe that top 20 companies forms 70% of the market cap and top 30 companies form almost 80% of the total market cap. It is very evident from this analysis that top 10 companies should be the most preferred destination for the investment according to me. Please note, this analysis is for education purposes only. Please do your proper research and analysis before making your own investments. Yeah. My next slide talks about the sectors, which is the next layer within the indices. Various companies and their stocks are aligned within standard sectors to ensure that we are able to analyze the sector performance as well. The sectors analysis is very important part of the ideation when any investor is planning his or her portfolio and investments. Let's look at the pie chart that I have available on the screen for you. The top sectors in Nifty 50 are IT, banking, conglomerates, FMCG, and after that the rest of the sectors follows. I have stacked up these sectors for you basis the market cap within the Nifty 50 benchmark, which is commonly used. This shows us several things for the investor to understand. Sectors like IT, banking, conglomerates, FMCG have the highest contribution in the sequence, and that could be a good trend for the investor to invest in them as a safer option or risk averse option available in the equity. The large companies are too big to fail. They have enough capital and resources which act as a cushion to withstand the strong economic winds. The rest of the sectors have low or single digit contribution in the total market cap in the Nifty 50 benchmark and should be regarded as an opportunity or growth sector within the Nifty 50. While these sectors are also while these sectors also have large cap stocks within them, they form small contribution in the Nifty 50 index from a market cap standpoint. In other terms, these smaller sectors have huge business opportunities as the world sees the emergence of India as the Asia's second largest economy and a global power. Sectors like renewables, chemicals, power, telecom, cement, luxuries, among others, have huge potentials to grow further. The investors who are willing to absorb small to medium risk can opt for these sectors as you know more the risk and the better is the reward. My next slide is rather very interesting as we now deep dive one level below into these sectors available in the Nifty 50 index. It is very important to understand the top sectors that are contributing in the Nifty 50 and the top three in companies directly responsible for this contribution. In the previous slide, we learned that the top 10 in Nifty 50 contribute almost half of the market capitalization than the rest of the stocks. It would be worthwhile to understand these top 10 stocks fall under which categories, which sector categories. This will also give you a sense which are these promising sectors, and maybe you can also analyze some of the competitors of these top companies in the same sector. From this slide, I want to draw the ideations for the investor to look at various perspectives from my analysis. The top 10 companies from the Nifty 50 comes from the sectors like conglomerates, IT, BFSI, FMCG, and telecom. Look at the top 3 stocks in these sectors sorted from large to small mid cap market cap already. In IT sector, which is the topmost sector by market cap, the top 3 stocks are TCS, Infosys, and HCL Tech. In this world of technology and digital disruption, these tech companies have a critical and vital role to play, an ideal stock to be included in the portfolio. Even Wipro and Tech Mahindra are great companies. We will learn more about these companies in great details in my next videos. The banking sector is the second uh, by market cap in the Nifty 50, right here, right here. Nifty 50. The top stocks are HDFC Bank, ICICI, SBI, Kotak Mahindra Bank, followed by Axis Bank. All great stocks to have in your investment equity portfolio. Friends, if you believe in the growth story of India and that India will be one of the top economies in the world by 2040, if India has to grow, the financial sector of India has to grow exponentially and perform to suit India's requirement in financial and banking space. This sector is likely and destined to boom further. The next sectors are conglomerate. The top ones in this space is Reliance, a group of companies that have a great success story of growth and transformation. I will be sharing a separate financial analysis on Adani companies, group of companies. The Adani stocks are latest addition into the Nifty 50, and it would be a good idea to have individual analysis done as historical data points are currently not there. The FMCG sector, known for the defensive stocks, are the evergreen and the fourth highest sector by market cap in Nifty 50. Companies like HUL, ITC, Nestle, and Dabur not only have great products and track records but have consistent CAGR over the years and quarters that make them hot destinations for the investors. I would request you to pause the video to view the complete analysis on all the slides. However, I have covered all the top data points for your references. All right. So, it is very important to stay updated with the latest global development that impact our daily lives. Hope this information and analysis was helpful to you. If you liked this video and the analysis that I have presented in front of you, then please subscribe to my YouTube channel and help this information to reach many others. My next video will cover the top companies with detailed financial and stock analysis. Thank you, and I will see you the next time.